Futures trading involves substantial risk of loss and may not be suitable for all investors.
Hi, everybody. It's time for Markets on the Move. I'm Marlin Bohling with you, your host, and joining me, of course, is Oliver Sloup, Blue Line Futures, with us here on a Wednesday. Oliver, as we begin here, man, there was so much news to talk about ever since late yesterday. We've got weird things going on in Poland with supposedly dozens of drone missions into Poland. That was weird. We had the PPI numbers came out. We have a lot of harvest activity starting to ramp up. A lot of stuff to talk about here today. So what was mainly on your radar when you watched the markets here on a Wednesday?
Well, as you'd mentioned, just a ton of news. We had the payroll revisions yesterday, too, which was much larger than expected.
Yep.
The news from Russian drones in Poland overnight, PPI this morning, CPI tomorrow. There are a lot of moving pieces in these markets, not just the agricultural markets, but a lot of these impacting the outside markets, which has kind of really piqued our interest in a couple of markets, particularly the crude oil market. But before we get into what we're looking at on that front, I want to kind of hone in on the grain markets real quick, even though it's been a little bit of a snooze fest over the last couple of days as traders just kind of jockey positions back and forth ahead of Friday's Wasde report. The average analyst estimate for corn yield coming in at 186.2. Being on the Pro Farmer Crop Tour, boots on the ground, talking with a lot of clients out there, I still think that that's probably a pretty optimistic number, but we'll see if the USDA is going to be quick to adjust or just kind of kick the can down the road. We'll find out Friday.
As I look at producer feedback and comments that kind of filter through social media, it's interesting to me, Oliver, that it seems to be about evenly split. Oh, it's better than I thought it would be. Oh, it's way worse than I thought it would be. And that almost makes me think, well, maybe it'll be about what they think. What do you think about that?
It's kind. I always talk to clients. This is like a Yelp review. You see a lot of really, really positive things and really, really negative things, and at the end of the day, it's usually somewhere right in the middle. At the end of the day, I've been in the camp really since last month's crop tour that this is probably still going to be a record crop. But the expectations were set so high going into that I think it probably falls a little bit short. There's some areas that really, really needed some rain through August, got really, really dry. Potentially you could make the case for flash droughts in some areas, and those areas aren't going to finish off well, and that's basically across Ohio, Indiana, Illinois, just the central part, just really, really dry. So I think the high expectations get walked back. What does that do for price? That's going to be the big question. Looking at the corn market here, we've got that chart pulled up here, and you and I have talked about this many times in the past few weeks, where we bottomed following that bearish Wasde report last month. To me, that just screams that no one was actually trading the 188.8 that the USDA came in at. Everybody thought that number is really high. That's probably a high watermark. We probably work backwards from there, and that's what the price has done so far. Now we're in a little bit of a holding pattern near that 415, 420 level for the December contract. We still have a pretty constructive technical backdrop here with higher lows and higher highs, but we really want to see this trend line support here hold, as well as the 20-day moving average and 50-day. That's the purple and red line. So long as we can maintain price action above that on a closing basis, I think the bulls have the advantage of break and close below there, and that would start to neutralize things a little bit and probably just set us up for more of a sideways trade here through the rest of the month.
Well, what about soybeans? Did they prove anything at all here on a Wednesday?
Soybeans have been really back and forth. We talked Monday about just being saved by the skin of their teeth at the 50-day moving average. We were able to bounce back and stage an impressive comeback, but over the last two sessions, we failed to really materialize any strength to the upside, and we're back down to that 50-day moving average, which is the red line. Not shown on this chart is the 100 and 200-day moving averages, which also come in right along there, as well as the 50% retracement at 1022. So you've got a lot of technical levels coming in between 10.20, 10.25. A break and close below that level, and you could really start to see the selling accelerate to the downside and snowball on itself. As you can see on this chart, there's quite a bit of air underneath this 10.20 level, potentially back down to that psychologically and technically significant $10 level.
How susceptible, though, is that soybean trade to international market activity?
You know, the soybean market, the big conversation recently has been the fact that China has really been absent in the soybean market. But the U.S. Does have the cheapest soybeans in the world right now. So there is, I guess demand has just been moving. Which is good to see. So what happens if China does come back into play, and how long can China sit on the sidelines? I think that's really the big question that's kind of keeping this market afloat on top of the acreage reduction last month. So I do think if we do pull back and we break below these support levels, you get near $10, you probably have a pretty good fundamental case for demand to just pick up even more from those levels. So it'll be interesting to see what the USDA says on Friday as far as global trade goes. Even without China, demand has been strong. I think obviously China coming into the market, that could really ignite this optimism to the upside. But for now, it's just kind of wait and see as the market seems to be in a push and pull zone.
Well, before we get into livestock and the other markets, is there any hope for this wheat market at all? I mean, they're starting to put the new crop in already.
Oh, man, I thought we were going to be able to sneak past the wheat market. But since you brought it up, we'll pull that chart up, and we've been just treading water basically for the last month or so. Today's session was a new low close, which is not really what you want to see if you're optimistic the wheat market, which would be this guy right here. I'm still optimistic that we can find some demand if we do drift lower near $5. The global stocks are still relatively high, which is keeping a lid on the upside. But I do think you get near $5, between here and $5, you do start to entice a little bit more demand. And then from the technical side of things, we just need to see some positive price action and consecutive closes out above resistance to get this market moving. You and I talked earlier in the week with regards to volatility. Volatility in the wheat market is at about a 5-year low. So if you're looking for a good risk-reward setup, I would think it would be to the upside with the options market being the volatility is low. You can buy pretty decently priced calls or call options to give yourself that upside exposure with limited risk.
You know, in the livestock trade, when you're talking about cattle, just when you think maybe the fat lady had sung, here it showed signs of life again on Wednesday.
Yeah, cattle. We'll start with the feeders because they were the exciting one in yesterday's trade. Lock limit down for the first 8 calendar months there, which gave us expanded limits in live cattle and feeder cattle futures in today's trade. Thankfully, we did not have to use those. But while we were lock limit down yesterday, had a lot of people asking, what does this mean? Is this top in? Are we going to continue to roll over? And I jokingly but seriously said, hey, feeder cattle, yeah, lock limit down. That generally means probably follow through to the downside, especially looking at the options market. When the market was locked, you can look at options to see where futures would be trading. The synthetics were trading at about 250 lower yesterday afternoon. I said, hey, if any market has the ability to rally after being lock limit down, it's going to be the cattle complex. And that kind of rung true today. It's just kind of a unique individual market that is very thinly traded. And just because you're lock limit down doesn't mean you're going to see some follow through. I do have some concerns, though. We did do some technical damage yesterday, breaking below trendline support in that 20-day moving average. Obviously, you can see that here for the November feeder cattle contract. If you look at downside support, you're going to be looking at this 50-day moving average, 336.75. You can also see that was an old high there just a few months back as well. So that would be kind of the next downside target if we cannot get back above what was previously support. And then over on December live cattle, similarly, you got the 50-day moving average working in here just below the market. That would be a downside objective if we cannot get back above what was previous support at the trend line and the 20-day moving average.
On the other hand, when you look at lean hogs, again, they're kind of taking over the leadership role now in the livestock complex, aren't they?
That's absolutely right, and there's been really a shift for the last week, 2 weeks probably, and you can really see it on the live cattle chart here, you see softening up over the last couple weeks right here, just rounding out the top, and then you hop over to lean hogs, and they've been firming. I think that's probably pricing in some sort of shift in demand. We have seasonal strength in the lean hog market. We had a clear technical breakout in the lean hog market a couple weeks back, and we talked about the potential retest of contract highs. That was finally achieved in today's trade. Where do we go from here is the big question. I wouldn't step in front of this on the short side. I think this market probably still has legs, but from the technical perspective, we like to look at previous interactions between buyers and sellers to kind of give us points to look at on the chart. And when you're at contract highs, you really don't have that to go off of, that roadmap. So it's just more of a momentum trade. We did close, below the old contract high, so it'll be interesting to see if we get some follow through. I still think there's some upside in hogs, but tough to chase it after the move that we've seen over the last 2 weeks.
Well, they definitely have a competitive edge at the retail counter over the beef, so they do have that going for them. Talk to me, if you would, for a second about the outside markets here and all the news developing and swirling around in the geopolitical realm. And, well, from about any angle you can think of, lots of tension going on around the globe right now.
There is, the headlines have really picked up over the last 24, 36 hours. Starting this conversation with you here today, we talked about the Russian drones into Poland. There's some attacks in the Middle East. Israel attacked Hamas. So a lot going on. On top of that, I think Ukraine bombed 3 more Russian oil pipelines. So there's a lot of risk out there. And so when we're looking at geopolitical risk, we're going to look to the precious metals market, obviously, but you and I have covered that enough that it would probably sound like a broken record. So we'll zoom in on the crude oil market here, and you can see that we're starting to get a little bit of a bid off of this support level that has really been intact for quite some time. And today, we're rallying to the upside. You see a little bit of overhead resistance at the 50-day moving average and trend line resistance. That comes in near 64.5, 65 for this October crude oil contract. Ahead of a long weekend, or not a long weekend, but ahead of a weekend, moving into the weekend with all this geopolitical tension and risk, I wouldn't be surprised to see the market continue to grind higher into that. And if we're able to get out above resistance, I think that's when you start to see this market maybe accelerate to the upside. Looking at the fund positioning, funds have their smallest net long position in crude oil since about 2006. So there is not a lot of risk premium in this market right now. If we continue to see these headlines pop up globally, and we get a technical confirmation of buying, I think this market could have some room to run.
Well, the latest petroleum inventory report, that was pretty bearish too, right?
That was bearish. We did have a blip lower this morning when that report was released, but that was quickly bought up on the back of these geopolitical headlines. We did have the OPEC meeting last weekend as well, and that kind of fell flat of some big concerns. I think people were expecting that to be more bearish, but they kind of laid the groundwork for production increases over the next couple of years, and it wasn't as much as they were previously expecting. So that's a little bit of a tailwind as well. But again, I think the wild card and the trump card here is these geopolitical headlines. It doesn't seem like things are cooling down right now. It seems like they're heating up. So that crude oil market going to be on our radar for sure.
Well, and then of course you can't forget about the stuff. Tension building around Venezuela now too, so they're one of the second biggest oil reserves, something like that, around Venezuela there, so that could play a role too moving forward. I know we talked before. If I'm a viewer out there in the social media verse right now, and I think your information is really cool, the charts and all that stuff, can I get them?
Absolutely. And before we get into that, just real quick, the crude oil market, there's a lot of different ways to play it. Options are great. The full-size contract, which is what was only available a couple of years ago, 1,000 barrels, that's a pretty big market. But the CME group did do a great job kind of bringing to life smaller contract sizes. So there's 500-barrel contracts as well as 100-barrel contracts. So the barrier to entry for new traders is quite a bit lower. Still, risk involved with futures trading, but a a little bit more achievable and attainable for a lot of folks out there. As far as the research goes, bluelinefutures.com, you can sign up there for a free trial of our daily commodity commentary. I cover grains and livestock each and every day. My colleagues cover reports in energies, equities, precious metals, etc. Matthew Bresnahan, who did the video with you last Friday, is actually doing a Wasde preview that we're going to put out on the site. So if you want to take a look at that, head over to bluelinefutures.com, hit that free trial button, submit your email.
Nice. A lot of stuff going on the rest of this week and into next week with the Fed meeting too next week, I believe, right? So anyway, we'll try and keep tabs on all of that for you, so keep it tuned right here. Oliver, great to visit with you again. I'll catch up with you on Friday. That's Oliver Sloup of Blue Line Futures. And that'll do it for now. Thanks again for joining us. We'll catch you on Friday. Take care.